Extraordinary moves in the oil market. We're currently down 25% on WTI. How much of a sort of perfect storm is this for oil prices at the moment, or can it still get worse?
I think it can get worse. What makes it a perfect storm is that this is the first real crisis in which we've had a demand shock on the one hand and a supply oversupply injected in the market for political reasons by major producers. So we've never seen that before as a coinciding set of factors. But yes, there's much more downside risk at the moment.
How do you gauge that? Why?
So you look at where demand is going, and then you compare it to where the supply is coming from, and you look at the indicators of where inventory is going to grow. You know, we think now that negative growth territory is where we are for the world economy as a whole. We're going to see negative oil demand growth. That number is an open-ended number. We're pretty sure it's going to be negative year on year, but we don't know how far negative. Let's assume that we have something in the U.S. and Europe that is similar to what we have in Korea, Italy, and China. We had a big hit, 70%, maybe even 80% at the peak in February of Chinese transportation fuel demand was lost. If we put that same number into the OECD economies, that could be a 12 million barrel a day loss for as much as a month. We don't have that figured into balances. If the market sees that the Saudis and the Russians are continuing to produce a lot more, and there's another demand shock on top of the current one, that's another big step lower in terms of prices.
So, Paul, I mean, it is brutal out there if you're an energy company. Marathon Oil right now down 47%. Apache down 46%. This is one-day moves. What's going to happen to these companies?
Well, it's going to be very hard for everyone. As Ed says, we don't really know where we're going, and it just becomes a question of how good their credit is coming into this and how much access to capital they have. And the second thing, which we've been pushing for 2 years now, is they all have to aggressively cut CapEx. So what we're looking for is the fastest to cut and who cuts the most. And we'd like to see Exxon leading the way there, but we've already had announcements today, for example, from Diamondback, Fang, Parsley. The fastest, best movers are already saying, okay, we're cutting.
Who's in the worst financial shape?
The two bellwethers amongst the high yield would be Chesapeake, that's trading the most today, and amongst the investment grade would be Oxy, are both really the bellwethers that we're looking at the credit for. The other challenge here, as you know, is that everything is traded by machines these days, so active managers are just on the sidelines, and we're just letting the machines do their thing, which is why you get these extreme moves, because there's no guy standing there with a piece of pen and a paper that used to be to control the market.
And whether it's machines or individuals, it's quite hard to price a binary outcome risk like a company actually going bust. What percentage chance, let's pick the two you just said, Chesapeake and Oxy, what percentage chance do you put that they go under? Is it a 1% risk or is it a 20% risk?
Oh, I think in the case of Chesapeake, it's an extreme danger, frankly. I mean, I don't
More
think
than
that's
50%?
a surprise. Yeah, I mean, I think I've got to be careful what I say because I don't cover the stock, and I wouldn't want to, get ahead of myself there. But it's certainly pricing extreme risk. It has scale still, Chesapeake, in terms of market cap. It's still over $1 billion, I think. Maybe not today, but was as of last week. So that's why it trades as very much as the bellwether. But you can see that the debt is trading at pennies in the dollar right now.
On the flip side, BP, a major company with a pretty strong balance sheet, was down 20% today. I mean, is there any chance that company goes bust?
No, I don't think so. I mean, I think the very biggest here, these global super majors that have been around for 100 years are going to come through this. I don't think there's any question about that. But they are in a competition, as Ed has referenced, with the Saudi balance sheet and the Russian balance sheet. That's really where you're at. So where we think the market balances, given what Ed's saying about demand, is US E&P and capex cuts and balance sheets. That's going to be the deciding factor. And we're going to have to cut US production by as much as the market needs to balance, which is just going to be a lower and lower price and worse balance sheet.
So, Ed, I mean, some of the chatter is Putin wants to put the U.S. fracking business underwater. I mean, is that really what's going on here? Talk a little bit about the political dynamic between Saudi Arabia and Russia and how the U.S. oil industry gets dragged in.
So there's no question but that the Russian companies would like to put the U.S. shale industry under. So we have to separate out. I don't know what Mr. Putin is thinking, but we've had the CEO of Rosneft make a series of comments from the middle of last summer to today saying we don't have to worry about Saudi Arabia. We're losing market share. We need our market share back. The real elephant in the room is the U.S., and there's nobody at the table in the U.S. The U.S. can't have a political leader at the table because of the nature of the U.S. industry, so it has to be driven down by price. Now, others have tried this before. The Saudis tried it in 2016 and 2014, as early as then, and they cried out uncle, and we'll see what happens on the Russian side.
How much ammunition or how much time do the Saudis have? Can they maintain this price cut, this price war?
Yeah, so they're both sitting on war chests. The Saudi war chest is about $500 billion in cash available. They were sitting on that same amount, maybe a little bit bigger in 2016 when they and the Russians got together. The Russians have built up a war chest, and they are much less vulnerable for several reasons. One is the world has cut Russia off from the rest of the world economy, so their liabilities in terms of hard currency are lower than Saudi liabilities in hard currency. But the real significant difference is the Saudi currency is pegged to the U.S. dollar. As prices go up in U.S. currency, their revenue goes up. As prices go down, their revenue goes down. The ruble actually floats, and it appreciates with oil prices. It depreciates with oil prices. That correlation gives it a kind of a boost when the ruble is low and prices are low and the cost of production is lower, and the chances of a company in a ruble-denominated cost environment expanding in that environment is much greater. So I'd say, they're both going to struggle at $30 or lower for a prolonged period of time, but in the short run, the Russians are sitting more comfortably.
Would you buy any of your companies right now, Paul?
I think that we like the best. So, an EOG or, particularly EOG, some of the very best stuff is very attractive right here. Absolutely. Yeah. One thing I'd add to what Ed's saying as well is we haven't heard the last from the president here. I mean, we could put in an import tariff. For example, they could stop releasing SPR and stop building SPR. There's a number of things that we might see if things get bad enough from the U.S.
Well, so far
government.
he's tweeted it's good for American consumers.
That was today. We'll see what happens.